Ina iwi, ina mana, ina hoa mahi, tēnā koutou katoa. Welcome everyone. It's wonderful to see you join us online for today's Treasury Guest Lecture Series under the theme Fiscal Policy for the Future. I'm Alistair Birchall, Head of Balance Sheet and Transactions here at the Treasury. And a very warm welcome to our presenters, Ian Ball, Dag Detter and Lucian Simmons. I'm just going to provide some introductory remarks about the theme and the topic that we're going to cover today. So the current theme to our guest lecture series is the future of fiscal policy. We chose this theme as a focus for our seminars to reflect the important role that fiscal policy plays in the living standards of all New Zealanders. It aligns with the fiscal focus of the 3 stewardship reports, which the Treasury is publishing over 2025. We released our draft long-term insights briefing a couple of weeks ago on sustainable and resilient policy over the economic cycle. We welcome your feedback with submissions due by 8 May. We are also publishing a long-term fiscal statement and an investment statement later this year. Speakers in this series are providing insights into how fiscal policy can support government to meet its current and future obligations while adapting to challenging circumstances. Let me now introduce our speakers who we are thrilled to have with us today. I will do it briefly and invite you to visit our website for more detailed biographies. Ian Ball is a former Central Financial Controller at the New Zealand Treasury, where he pioneered the Public Finance Act. Ian also initiated and led the development of the International Public Sector Accounting Standards. He is currently an Adjunct Professor at Victoria University of Wellington, and until recently, he led the Audit Advisory Committee for the financial statements of the New Zealand government. Welcome, Ian. Dag Detter is a renowned financial advisor to governments, recognised for his role in restructuring Sweden's national asset portfolio. He's a co-author of influential economic books and a global authority on public asset management. Welcome, Dag, and let me emphasise that we really appreciate your flexibility around the time difference with Dag joining us from Sweden today. Finally, Lucian Simmons, with a background in banking and advisory, is a senior analyst here at the Treasury, and Lucian is leading the development of the Treasury's upcoming investment statement. I'll now talk a little bit about today's topic. So today, Ian and Dag will explore how governments can unlock value by optimising the management of the assets on their balance sheets. Ian and Dag will advocate for strategic asset management as an additional tool to support fiscal sustainability without relying solely on tax increases or borrowings. These topics are relevant for New Zealand as we consider management of assets and liabilities as part of our 2025 stewardship reports, including the investment statement, which focuses on the management of the Crown's balance sheet. I'll now say a few words just around how the session will be run. So Lucian will set the stage. He'll provide an overview of the work that Treasury has done around the investment statement, and that will provide a backdrop for Ian and Dag's presentations. Following that, we will have some time for discussion. Just on logistics, we ask that you use the Q&A function in Teams, so please post your questions there. And if you have any technical questions or queries, please use the chat function. I'll now turn to our first speaker. So Lucian, over to you.
Thanks, Alistair. Just give me a second to share some slides. Hi, everyone. I'm going to start today by providing some background on investment statements, what they are and why we do them. And then I'll give a brief overview of the government balance sheet. New Zealand regularly publishes an investment statement, and we see this as a good discipline to ensure we keep the balance sheet under review. The first investment statement was published by the Treasury in 2014. We've now been through 3 iterations of the document, with the latest published in 2022. The objective of the investment statement is to support a better understanding of the government balance sheet. It does this by requiring that each report describes the state and value of significant assets and liabilities, how they've changed over time, and how they're forecast to change. This information provides several benefits. First, it supports transparency, with a deep dive into balance sheet matters supplementing the regular reporting in the monthly and annual financial statements of government. This additional detail can then inform and support decision-making about active asset and liability management. It also helps with the identification of risks and opportunities. The Treasury has used the investment statement as a key stewardship document, including disaggregated analysis of the government's assets and liabilities, as well as engagement with new challenges. For example, in the past, this has included applying the living standards framework to balance sheet management and quantifying the impact of shocks to the balance sheet through stress testing. The 2025 investment statement will continue this approach with the focus on how the balance sheet supports fiscal sustainability and economic stability. It will include Treasury's views on how the balance sheet can be used to meet our infrastructure needs, improve asset performance, apply capital to its highest value use, and better understand and manage risk exposure. We'll have more to say on these topics later in the year. The Treasury considers there is a case for more active management of the balance sheet. Government assets have increased significantly in recent years, reaching $571 billion at the end of the last financial year, more than double that of a decade earlier and equivalent to 138% of GDP. The bulk of these assets, $284 billion, is property, plant and equipment. To put that number into perspective, the value of property, plant and equipment is about 120 times the allowance for new capital spending in budget 2024. The Crown's balance sheet is now very large, so even small changes in system settings can make a big difference in terms of returns, costs, and services delivered. The majority of assets are held in what we refer to as the social portfolio, which is entities with the purpose of providing public services. These assets include roads, schools, hospitals, national parks, and so on. The next largest group is the financial portfolio, which holds assets that are predominantly used to pre-fund government expenditure or obligations. The majority of these assets are held by New Zealand Superannuation Fund, ACC, and the Reserve Bank. The last group is commercial assets, which represents the government's ownership interests in commercial entities, such as Air New Zealand, Transpower, and Kiwibank, among others. Government assets are mainly funded by debt. About half of total liabilities is sovereign debt, with another 14% of non-sovereign guaranteed debt held by SOEs and Crown entities. 18% is insurance liabilities, which mainly relate to ACC, and the rest is a mix of payables, provisions, and other items. The difference between assets and liabilities is net worth, which has increased faster than assets and is now sitting at $191 billion, equivalent to about a third of total assets. The primary contributor to this increase is revaluations of property, plant, and equipment, which has been driven mainly by increases in the value of land. This presents a challenge, as we now hold a lot more property, plant, and equipment, but we haven't always been thoughtful about what we need to own or what the most effective ownership structures are to deliver the best public service outcomes. That's it from me. I'll now hand over to Ian and Dog to hear their views on how we might be able to improve the management of the very significant resources sitting on the government's balance sheet. Thanks.
Thank you, Lucian. Can people see my slides?
Yep.
Well, good afternoon, everybody. It's great to be part of this session. While Dog and I have equal billing in this presentation, I'd have to say that I see myself rather as a support act, in the sense that there are two key messages from the book that led into this session. The book is Public Net Worth. It was written by Dog and I and 3 other co-authors. And within that book, there are 2 central messages that run through it. The first is the necessity for balance sheet focused accounting information as a basis for government's public financial management systems. And the second theme is that set of information enables more productive management of public assets and liabilities with a potential generation of non-tax revenues. Now, in the context of the book and in the context of a presentation to the primarily to the New Zealand Treasury. I think it's quite important to put the information set, if you like, the first point on this slide, into an international context. I was recently speaking to a group of accountants in one of the New Zealand government departments, and it's fair to say they had very little sense at all of how the New Zealand set of public financial information sat relative to other jurisdictions. So I wanted to spend a little bit of time just locating the New Zealand information set in that international context. When I say in this slide the necessity for balance sheet focused information, that's really just another way of saying accrual accounting. A technical term for it is, if you like, accrual accounting. Accrual information is the set of information that you would normally see, for example, in a company's set of financial statements. It includes a statement of financial performance, a statement of financial position, fiscal position, if you like, plus cash information through the cash flow statements. And clearly that set of accrual information provides a much more comprehensive basis for managing the public finances than does cash information alone. When I talked with those accounting staff recently, they had no sense that some governments might not produce this same set of information. And in fact, on the slide, we can see that in a 2020 survey conducted by the International Federation of Accountants, we can see that there are relatively small, let's say approximately a third of the governments that were surveyed use accrual accounting. Some are using partial accrual accounting where they may have some assets recorded or some liabilities recorded, but it's not a complete accrual accounting system. And some have a purely cash system where their accounting system is simply cash-based. So that really is a quick summary of the state of play globally. What we can see is that in the OECD countries, that's a little bit different. In the OECD, approximately 3/4 of the governments now have accrual-based information in their annual financial statements, a fewer in the transition, and a number are still on cash. However, that's the case for financial reporting. It's not so much the case for budgeting and appropriations. And looking again just at the OECD countries, we see that the majority of countries still operate their budget on a cash basis, while a number have a cash and accrual basis, and a reasonable number have their budgeting on an accrual basis. But when you then take it one step further and look at how many countries have their appropriations, their budgeting, and their accounting all on an accrual basis, it really comes down to, amongst the OECD in this study, 2 countries, New Zealand and the UK. So the IMF noted recently that only a handful of countries currently undertake a public sector balance sheet approach to their public financial management. And I guess what I mean when I talk about a balance sheet approach is a public financial management system that really has that full set of accrual-based information, balance sheet included, as the core information in their decision-making processes. So what we see in the New Zealand system is exactly that. Accrual information is central. The departments operate entirely on an accrual basis, and the whole of government, accrual numbers run through the principles of responsible fiscal management, the budget process, including the budget policy statement, appropriations, in-year reporting, end-of-year reporting. So in that sense, the set of information that you would want to have in order to manage your assets well, it's in the New Zealand case, it's so far so good. And a lot of early part of the book was about explaining in the international setting why that set of information was useful and how it was useful. But I think it's also important to understand the quality of information that a lot of governments use. I think that's not widely understood. And I'm going to take an example to illustrate the poor quality of information in many jurisdictions. And that is the audit. And what do we find when we look at audits around government financial information? What we find is that in the New Zealand case, the government's financial statements get a clean audit opinion. That's also the case for the UK. That's also the case for Australia and Canada. But when we look elsewhere, we see some evidence of quality of reporting, quality of information that's really quite disturbing. And so I've taken what might be a slightly extreme example from the United States, but the United States is a technologically advanced country. And this is really quite an interesting depiction of where they're at. So what we see is that in the period since 1997, when the US government first started producing consolidated financial statements, they have yet to receive an audit opinion. That is to say, they've never got themselves to a point where the auditor was prepared to express an opinion. So they've received what we call a disclaimer. And that arises when basically the auditor can't obtain sufficient information to provide them with the basis for an opinion. And when you think about the United States government, that's not having that reliability of information. That's a serious situation. Perhaps just to emphasize the point, I've used one example from the Defence Department where in their annual report, they have more than 500 unsupported accounting adjustments that were discovered in 2 quarters of the fiscal year 2024. Those total accounting adjustments, basically adjustments that were made without adequate evidence, they total 245 billion. And that's against an appropriation of just over 800 billion. So the amount of unreliability in that set of financial statements is really very concerning. And I think in New Zealand, one of the things we need to understand is that we have a very good set of financial reporting institutions and they need to be well maintained. But there are some issues, and I'd like to identify a couple of the challenges that we face and other governments potentially face. The first is the question of how we value our assets, and the accounting standards that we in New Zealand use and the international public sector accounting standards allow historic cost as an option. And until relatively recently, they have also used market values as an alternative valuation concept for fiscal assets. Now, the International Public Sector Accounting Committee has recently put out a new standard which says that those assets like property, plant and equipment, land and buildings are not any longer to be valued at their highest and best use. They're to be valued at their value in their current use, current value measurement basis. The current use is the basis for the valuation. And that's a significant change in the sense that it can discourage reallocation of resources from one use to another. And in his presentation later, Doug will refer to the case of a school on the Copacabana in Rio de Janeiro. And that's a prime example of the sort of issue that can arise when the valuation basis does not enable assets to be valued at their highest and best use. In the book, we identify 3 technical challenges to the use of the balance sheet as a mechanism for financial decision making. Those are the existence of non-financial capitals, the sort of capitals that are reported on within the living standards framework, the role of the comprehensive balance sheet, which is the, if you like, the existing financial balance sheet plus the discounted values of future revenues and less the discounted value of future expenses. That's also something which in New Zealand is already catered to, in the sense that the long-term fiscal statements do essentially approach a comprehensive balance sheet. It's not a complete balance sheet, but it's used as a basis for estimating long-term net worth. But perhaps most importantly, the issue that concerns me about the quality of information that we have in New Zealand and the quality that we will have going forward is in the relationship between tangible and intangible assets. Essentially, what's on government balance sheets at the moment are tangible assets. They're assets that you can stub your toe on. What I want to do here is just identify that over the past 3 decades, if you like, in the period since the Public Finance Act was passed, the nature of the global economy has changed significantly. And that's reflected in the relationship in this chart between the balance sheet, or the value, the capital value of a company, and the value of the tangible assets on its balance sheet. What you can see in this diagram is that at the beginning of the period, roughly, let's say 1975, the majority of the value of a company, this is the S&P 500 companies, the majority of the value of the company, 83% of it, was on the balance sheet. But then what you observe over the following decades is that progressively the value of the company has got markedly greater relative to the value of the assets on its balance sheet. So in 2015, the value of the tangible assets was 16% of the value of the company, which raises the question, which I think is as appropriate to governments as it is to companies, is how is value created? What is it that they have that's of such value but is not showing on the balance sheet? This seems to me to be a significant threat to the quality of the accounting information that's on the government's balance sheet and on corporate balance sheets. The difficulty with this issue is that the accounting standards don't enable intangible assets like intellectual property, brands that are internally generated to be placed on the balance sheet. I suppose the good news is that as a matter of urgency, the International Accounting Standards Board has now adopted a project to do a comprehensive revision of the standard related to intangible assets, which could result in a very different structure of our balance sheet, but that may not occur for some considerable time. I will skip over this slide just on the basis that Lucian talked about this New Zealand government's balance sheet. Perhaps just to add, this is a slide taken from the recent or the forthcoming article by Gill, Gemmell and Grimes, which looks at the growth in the Crown's balance sheet over the past 3 decades. And as Lucian said, you can see the extent of the growth and the extent of the tangible assets that are on it that are subject to the if you like, the need for improved asset management. So at this point within New Zealand, I think we see two significant management challenges. The first is a more balanced perspective on the fiscal position, and the second is better management of public assets, which is what Dog will shortly talk about. In terms of the role of net worth within the government's fiscal strategy, what I'd suggest is we need to think again about what's the relationship between debt and net worth, and how do we use those within our fiscal strategy, and essentially argue for a more balanced view between the picture that's accorded by looking at debt and the picture that's given by looking at net worth. And essentially this comes off the notion that the government is a very large, very complex organisation that has a very large and very complex financial position. And the notion that you can capture adequately the fiscal position of a government in a single metric is simply unrealistic. The debt alone ignores all of the asset side, and even if you take account of financial assets, it ignores the property, plant and equipment, and debt also ignores liabilities that are not debt, which amount to about a third of the total liabilities. So if net worth is a more complete representation of the government's assets and liabilities, then the case that I would be wanting to make is that we should pay much more attention to net worth within the fiscal strategy. And in part because it's more comprehensive, and in part because it generates a different set of incentives. A net worth focus makes much clearer the difference between investment expenditure and consumption expenditure, and they impact differently on debt costs. And I've just included here a quote which you can access should you wish, which looks at what do you find when you look at the impact of debt versus net worth on a government's debt costs. And what it concludes is that, to use the quote here, the central country-specific fiscal factor driving government bond yields, and hence government borrowing cost and fiscal sustainability, is government net worth rather than liabilities. So that presumably provides some incentive to think again about what's the role of net worth within the fiscal framework. Within our existing fiscal framework, that those incentives could be stronger. There's a number of ways we could do that. Net worth, the role of net worth could be more integrated with the annual cycle. Lucian outlined the long-term documents that the Treasury produces every 3 or 4 years. The long-term fiscal statements have emphasised the deteriorating position over the long term since they were first produced, and I think it's fairly clear that we've not seen a significant change to address those concerns. We also see that in the current fiscal strategy there is, it's a good thing, a numeric target for net worth to be maintained at around 40% of GDP. But there was very little explanation of why 40% of GDP. It was the government had a net worth to GDP of 55% in 2008 before the financial crisis, and the current level of net worth to GDP is 46%. So a 40% target is a rather unambitious target. So I think the key point I'd want to make here is that what we need to do is to integrate the concept of net worth far more closely into the budget process and into the fiscal strategy. What we see in New Zealand is that we have good accounting information. It's at some risk, but it's fundamentally good information at this point. And it can inform and incentivize decisions, but it doesn't prevent bad decisions. The quality of the information doesn't preclude bad decisions being made. It just enables better asset management decisions to be made. If you want to get more productive use from the assets, and ideally have them contribute to the generation of significant non-tax revenues. And at that point, I'd like to pass over to Doc.
Thank you, Ian. Now to Doc.
Thank you. I'm going to put on my slides. There we go. Can you see this?
We can see those, Doc.
Thank you. As Ian has been saying, I mean, New Zealand is in a unique position globally with such unique accounting that basically no other country in the world has. So New Zealand should be extremely well positioned to manage their assets. My own journey with managing assets started when I was an investment banker in the 90s, and Sweden was going through an economic crisis. And one of the recipes that was recommended by stakeholders and the IMF, etc., was to privatize, which was the consensus, or the Washington consensus at the time, and had been executed in many countries from Germany to the UK, etc. However, the Swedish government understood the problems of public ownership and realized that the old model from the Second World War, which was basically very much of a socialist state capitalism model, was not working anymore because the world was different. Globalization, the digital revolution, mobile phones and internet made a lot of these business models completely obsolete. We had 60 companies that was representing about 1/4 of the domestic business sector, the largest employer and some of the biggest companies in the country that were like a big millstone around the neck of the government, and was quite strongly a problem for the whole economy because of its size and its complexity, etc. So the idea was, instead of privatizing the whole portfolio, was to make it work as if it was privately owned, introduce private sector discipline. And we did this by introducing value maximization as the objective, outsourcing all public service obligations and subsidies, and have a proper capital structure, dividend policy. We recruited new board members that were no politicians. So 85% of all the non-executive board members were replaced with professionals. 75% of the CEOs were replaced with professionals, and 50% of the CFOs. And this resulted in quite a change of the value of the portfolio, even outperforming the local stock market in quite a trying time financially, globally, and in Sweden. This resulted in that this experience became some kind of a model for the World Bank and IMF, and I started to work internationally, trying to implement similar schemes in different countries. And a few years later, even wrote a book that then inspired the IMF to do research on public wealth management. And that research in 2018 came up with the idea that the value of public wealth was even larger than we had expected or estimated in our book. It was estimated to be 2 times GDP, and if professionally managed, could generate non-tax revenues of several percent, or 3% was the IMF number, every year. So that was a big boost to this subject internationally. But historically, Singapore has been the leader in public asset management. You could say that Singapore is to public asset management what New Zealand is to public sector accounting. So those are basically the 2 leaders that I hold up as the standard bearers of good things in this topic. And Singapore basically used public assets management as one of the ways to move the whole economy from a developing economy to a developed economy in one single generation. And the main holding company, they created 4 different holding companies to manage their assets. So financial assets is GIC and the central bank, etc. But Temasek managed the operational assets. So that's what some people call SOEs or crown entities, etc. But the overriding term to make things simple is operational assets. And that holding company was started in 1974 and went from less than $1 billion to 300 billion in 60 years, with a 14% shareholder return, and together with the other holding companies, has now over these 60 years created a sovereign portfolio which is 4 times GDP, and probably the biggest sovereign portfolio anywhere in the world, even compared to countries like Norway or Saudi Arabia, that has generated wealth out of the exporting natural resources. And we must remember that when Singapore set this up, it was when they were made independent in the 1960s, they were separated from Malaysia. And Malaysia has all the natural resources in the world you could think of, like everything from oil, gas, and agricultural and other resources, while Singapore has nothing. So they've basically created this wealth by pure wit, willpower, and diligence, which is, I think, is a good model for all countries that do not have natural resources. It is possible to manage your assets and your capabilities in such a way. And at the same time, the Singapore government has provided 80% of the population with housing, which I think is a very important aspect of this. Globally, public assets or public is worth 3 times GDP, because what the IMF study didn't include was real estate, because that is one of the most hidden parts of assets in a government. So public assets are really 3 times GDP, 3 times global stock markets, the value of global stock markets. Half of it is commercial assets, in other words, the operational side, and real estate. So operational assets is everything that is providing a service or a product to society. So it's everything from transport, utilities, or financial services, manufacturing, etc. And the real estate, of course, is building and lands, etc. And real estate is often twice the size, at least twice the size as the operational side. And the important things to remember is to make these, to manage these for best and highest use. And as Charlie Munger usually used to say, is it all depends on the incentive system. If show me the incentive system and I'll show you the outcome. And this is a very important thing to remember when we're trying to set up a system for this, which requires data, which of course New Zealand has best in the world, and then creating the institutions, just like we've created a central bank for interest rates, a debt manager for managing the debt, etc., or pensions. We have created professional independent institutions, but also what is left to set up is the independent professional institutions for also managing the assets, and then recruiting the capacity for that. And of course, it's curious that global governments around the world is so bad at collecting data and understanding data and keeping the data on the assets, while 1,000 years ago the Willem the Conqueror did the Doomsday Book and did just that, and still we haven't learned that lesson, because hidden in every city especially are huge amount of real estate, often worth at least 1 times GDP of that city, and representing about 50% of the real estate market. While the book value outside, we're talking outside of New Zealand, but that's just to make you perhaps see how fortunate you are that you have created this accounting system in the public sector. It's only a fraction. And the worst example I have found was Pittsburgh, where the book value was, or the indicative market value was 70 times book value in the financial statements. And there are many interesting examples. The classical example is the one Ian mentioned in Copacabana, where the IMF economist Vito Tanzi found a school at the beachfront road, which was a 3-story high school among all the 5-star high-rise hotels. And the simple idea that caught him is how bad the public sector is using their assets, because by moving this school and building a much more profitable commercial asset or real estate like a hotel, the local government could make so much money that they could build several schools and create a much better environment for the children, instead of having to be seduced or attracted to the beach. They could be a few blocks away at a much cheaper real estate price and generate money for the whole community and for the school. So having this view that and having the data so that you can really understand all in every moment, what is the best use of every asset, be it real estate or an operational assets. And to do this, it's very important to understand, that we are really trying to be commercial about our assets. If we determine that they are commercial, in other words, they are sustained through external non-tax revenues. If they are sustained by tax revenues, then I would call them policy assets and put them in a different bag to be managed differently. But all the assets that has the capacity to generate non-tax revenues, they should you can say, play rugby instead of playing football, but you have to decide what you're playing. Are you managing policy assets, or are you managing commercial assets? So the first decision is always to put the portfolio of assets, real estate or operational assets, in the respective bag. And that's quite obvious to do when it comes to operational assets. Real estate assets, it might be, it feel different, but there it's important to separate. So let's say a hospital, the operational side of the hospital is the operations. The real estate should be split off from that, because as an operation develops, the need for facility changes. So it's important not to be tied to a certain asset, because a real estate asset is like a bottle. It can be used for different kind of liquids, and there shouldn't be too close a tie. And that's why every real estate asset should be really valued for a highest and best use, because that will force us to really think, how do we use that best, and how do we maximize the operations for the best benefit of society as a whole. And once you realize that these are commercial assets, they should have a commercial objective, proper accounting, and political independence. And just like other institutions that has been set up to manage something professionally, we should also have professional institutions to manage our assets. And it should not be managed by politicians, because politicians should be doing the policy work, and professional asset managers should be doing the management of assets. And to have this separation is core to make good professional asset management in a government. And the two different types that we're talking about is a public wealth fund and a sovereign wealth fund. The sovereign wealth fund are probably the most familiar ones. They manage the excess liquidity that you generate when you sell, let's say, natural resources, etc. But the public, and they invest internationally in order not to create a Dutch disease. The public wealth fund manages the domestic assets and their subsidiaries, perhaps abroad, to maximize value, and that is a completely different game from what a sovereign wealth fund does. And the example, of course, in Singapore is Temasek is the public wealth fund, and GIC and MAS is the sovereign wealth fund. And the holding company is this bridge between the private sector and the public sector, which makes it possible to work together and actually create a much more healthy relationship with the private sector, to avoid things like PPPs, which doesn't really work and is only benefiting the private sector. Because what we want to avoid, the purpose of everything is to make sure that tax money is used as efficiently as possible, and that there is a benefit to the society as a whole, not just to one commercial partner. And there are lots of examples, both at the national level and at the local level, where this has been done successfully. And the City of London was probably one of the first public entities that actually saw public asset management as a key role for the government. And of course, key to this is to recruit the right professionals and not having any policymakers in this role, because the three strategies to improve the value of an asset is operational, capital structure, and business development. And they all require different kind of experiences and skills. So it's better to try to mix both the non-executives and the executives coming with different skills and bringing that into the management and the governance of an asset. And of course, also to minimize risk and not just to maximize value requires a separate skill set, none of which are policy making. Because the value maximizing process is, of course, to have a business plan and then a strategy, and then acquire and dispose of assets that will improve the value of the assets without selling anything too cheaply, which is otherwise the standard procedure for governments when they try to clean up their balance sheets to generate cash for the budget. And the reason for this is that the public assets, when you manage a public assets, and this was a big surprise to me when I went in to manage the Swedish portfolio, was that the key thing compared to the private sector, which has clear commercial goals, in the government sector, the goal for the individuals running the assets is not to make them as profitable as possible, because then you will have to give away dividend. And in order, the survival instinct immediately when you enter as a manager of a public asset is to try to retain as much capital as possible, because you know you will never get it back, because then you have to fight with other expenditures in the budget. So the instinct of anybody running a public asset is to create a conglomerate. So in other words, when you're trying to make them more profitable, the first thing, one of the first tools is to actually streamline and take away and sell and divest or outsource all the things that are not absolutely necessary to handle the service that is required by the government and the reason for their ownership. And we have several examples of where this has been very successful. Of course, Temasek is one of the leading investment companies in the world, even compared to any private sector entities. The Swedish example was also quite successful and helped to create fiscal space and improve debt sustainability and economic growth and increased competition in the country substantially, and productivity, of course. Hong Kong is another extremely interesting, where the government, when Hong Kong was growing, realized it needed a substantial investment into a rail network, both on the ground and underground. And they managed to build a network the size of New York City without using one tax dollar. Everything was paid by developing the real estate above and around the stations. And it's still probably one of the best subway systems in the world. We did something similar in Sweden when we demerged the real estate in the railway company and managed to pay for a doubling of the capacity of the railroad tracks and created a huge amount of housing and commercial assets above the tracks by decking over the tracks and finding railway yards that were unused, that created a Silicon Valley or innovation district in the middle of the city. The UK did something similar with their railway stations. Copenhagen has created the biggest property development in Europe, 5,000 square kilometers with more than 30,000 residential units, and help fund the extension of the subway. Hamburg in Germany has done something similar, which helped pay for many infrastructure assets. And we have several examples in Sweden. And I find it very interesting how being able to do this without spending money is an enormous trigger to build housing and other, which is housing in itself is of course a secret economic growth engine, because by having more houses you create mobility, and with mobility you get a much more productive economy. So proper accounting and asset management, in my view, in our view, is a critical element of creating long-term financial sustainability and productivity, economic growth, and a way to get re-elected. Thank you.
Great. Thank you so much, Dag, and thank you to Ian as well for your presentations. Maybe a couple of quick observations if I just summarise the sort of key themes that came through there. So I guess in Ian's presentation, really around the importance of accrual accounting and the base information. And then a piece around integration of how we think about the balance sheet as part of fiscal strategy. And then on Dag's side, a real thematic about the potential to manage public assets better, with some really rich examples drawn from Sweden and Singapore in particular, as well as a range from around the world, including both countries and municipalities. So thank you both. We now have time for questions, and I'll direct these to Ian and Dag. We've had some come through the Q&A function. So perhaps I'll direct one to Ian. So we have a few questions that have come through the Q&A, which I guess focus on the question of whether there is a sort of optimal level of net worth, and also, how we should think about, net worth as being different to how we think about fiscal space in a traditional sense around debt capacity. So, maybe turn to you, Ian, for those.
Thanks, Alistair. I don't think we really know exactly what is the right level of net worth, and I think that will depend very much on if you're looking at it in an international context, it'll depend very much on the country, what its risks are, and so on. So New Zealand is quite an exposed country, and in that sense, one might argue that the level of net worth would desirably be higher rather than lower. I implied and would observe that New Zealand seem to recover relatively rapidly, both in terms of restoring restoring net worth, but also economic activity after the global financial crisis, when prior to which, as I said, the net worth to GDP was 55%. I think there's obviously a limit to you're not wanting to have the government with the largest possible balance sheet. But I guess my view would be that the ambition of the government to have it around 40% seems to me to be relatively low. I think the other issue that I'd just identify is that it depends quite a lot on the structure of the assets and liabilities that you've got on the balance sheet. So you'd want to be considering that in determining what level of net worth that you might want, because that impacts on the level of risk that you can deal with in short and long terms.
Yeah. Thanks, Ian. So we have another sort of cluster of questions where they're focused really on how do we think about value in a kind of sovereign or government context. And so the quick question here is effectively, in a commercial context, it's kind of clear what the objective is, but how do we think about the question of best use when, government has sort of often mixed objectives? So maybe, Dog, I'd be interested in your views.
Well, let's separate what is best used for an operational asset and what is best used for real estate assets. I mean, for an operational asset, I think it's best use is to make an operation work as efficient and as be as productive as possible. And that is not, in my view, that is not in contrast to being, extremely valuable or maximizing the value. Because if we look at a train operation, I mean a railway operation, we should compare that, a train or electricity or logistics like a post office or an airline or an airport, etc. They should be as efficient as any of the best in that sector. And you should compare yourself with the best in that sector anywhere in the world, and you should learn from them. Because if you do that, and if you have value maximization, which is a very simple way, I mean, it's the same like net worth. Of course, there's no, you can debate this in ad infinitum, but to make things simple, to align all the interest in society, but also inside the company, you make it much easier if you say maximizing value is our goal, because that will increase productivity. And if you increase productivity, we will be better at delivering the services that we're trying to do. It's when you confuse the objective and have one or two, more than one objective, that's when you get into trouble, and you will have operations that will not understand what their real goal is. So I would say the important thing here is to simplify the objective and to be less intellectual about it, if you like, but to really say we're going to be extremely efficient, profitable, etc., because that is the way that the community will profit from this. And actually, you could say the same thing about real estate, because if you make sure that you are using real estate at its highest and best use, let's take a hospital. A hospital needs to be very efficient, and the needs of a hospital, this is an operation that changes the nature of a hospital. The technical nature of a hospital changes really rapidly, because the science of caring for people changes very rapidly. So we need to be able to shift with the facilities for a hospital more easily. And we can do that more easily if we have real estate that is very agile and able to be customized for a hospital, or changed the facilities or expanding them. It's the agility that you have with, first of all, separating the real estate from the operation, but also making sure that both entities actually are acting in the same way and as productive, and think about productivity, best use of space, as if they were privately held. It's the confusion in the public sector that we think we're trying to confuse the goals that makes the public sector so unproductive and wasteful of resources.
Thanks, Dom. Perhaps back to you for one further one. We've got a question which notes that state-owned enterprises in many cases have market power and don't operate in perfectly competitive environments. Doesn't maximisation of value imply that they will exercise that market power at the expense of consumers?
Yes, I mean, we have, I mean, many of the especially in developed countries, many of the assets are on either natural. I mean, water is the most natural monopolist of all, but sometimes electricity can be it as well if the market is not big enough. Certainly railways. But if you take railways, first of all, I mean, there is a way of creating competition by separating the railway lines from the operation. It's the same thing like separating the real estate. So by doing that, you can introduce competition on certain lines. So I haven't been to New Zealand, but my guess is that you would probably have a very profitable, or at least a potential to have a profitable traffic between your two biggest cities, at least there it would be possible to have competition on the so that several companies can compete on the services between those two cities, which is often the case. The difficulty comes at the other ones, and the best thing you can do then is to separate what the operations that needs subsidies to be sustained and the ones that can be run commercially. And of course, regulation also plays a very big role, and a strong owner, which is extremely commercial, and as we discussed before, separate out to dismantle conglomerates, because that also increases the power, so that you can really see how efficient are they in the service that we want you to deliver, which is a really high-class, productive, low-cost service between, I guess it's Wellington and Auckland, that would be the case here, because that's what you want. And that will also improve, of course, which is the goal of the government, the economic activity to flourish between these two cities.
Thank you, Doug. To you, Ian, we've got a question here which notes the discussions emphasise the good incentives from using a full public sector accrual accounting approach, but it asks the question, but won't the pursuit of net worth bias investment towards assets that can earn revenue versus social assets, even though the latter may contribute more to well-being? So I wondered if you had a perspective on that issue on incentives.
Yes, thanks, Alistair. The suggestion that it will a focus on net worth, I don't think necessarily biases the decision making in that way. If the decision makers are conscious of what the value that's generated by the respective assets is, that is to say, certainly there needs to be analysis of the social assets or the value created by the social assets, and that can be compared with the value, which may be revenue generation from the commercial assets. I don't think that implies that the government will always have a preference for investing in a commercial asset. The suggestion is not really that net worth becomes, that you're not aiming to maximize net worth. It's merely that you're aiming to have a sufficient level of net worth to provide the resilience that you're looking for. So you still need to do that evaluation, and it's not a net worth maximization. I mean, in a sense, what I was really trying to convey was that debt is an important factor to consider, as is net worth. It's not an issue about whether or not we just use net worth. We're also considering debt. We're looking at the structure of the whole balance sheet and what our mix of assets is, and considering what's the optimum for the government as a whole. At least that's what you're wanting the ministers to do. There may be an element of bias towards investing in a productive asset or a revenue generating asset, but so long as it's clear and transparent what the benefits and costs of each are, I don't think that should lead to adverse decisions.
Yeah. Thank you, Ian. I think perhaps I'll put this to both of you, interested in your perspective. So this is, how do we start to think about, understand and manage the implications of increasing climate risk on public assets? Yeah.
Ian, go ahead.
Okay, I guess I'd start by saying the obvious point is that with a really good information set, you're at least very much more aware of what public assets are at risk. If you know exactly what assets you've got and where they are, then you're in a much better position to assess the risk associated with that portfolio of assets. And that clearly is a first step to evaluating then how will you manage the risk over time. I think the other point that I'd raise is that the climate-related risks are increasingly being accounted for. For example, the private sector in New Zealand is just starting to adapt to that. At the present, that's not applicable to the government. So I suppose another way of thinking about this is whether or not the same sorts of requirements that apply in the private sector to reporting on the financial consequences of climate risk could also be more explicitly accounted for in the government sector.
I think the only thing I could add is that, by really understanding, especially real estate, where your real estate are, and the function and its value and best use, etc. That is once a disaster strikes, which is something that you in New Zealand are quite familiar with. This is extremely helpful to really understand where all your assets are and what they've been used for, because in the recovery, you need to understand that quite well. Because it's always easier to rebuild something than starting from scratch. And I think you have a much better view of this than any other governments. However, I think even in New Zealand, you probably would benefit from having an even more detailed understanding of what each department, each SOE, each Crown Estate, etc. owns, and to be able to handle both the risk, but also handle the recovery from any potential disaster.
Thanks, Doug. The question now, I think, probably most suited to Ian. So put a question in the chat, which is really around the integration of the balance sheet and fiscal strategy. And it's asking really two points. So I guess, what are your views on sort of how you bring the balance sheet into the fiscal strategy, bring them together, and whether there are examples that you're aware of, particularly outside New Zealand, which have done this well? I guess over to you, Ian.
Yeah, okay. I'll answer the second part first. I think most governments that are trying to move in this direction are probably struggling, and we used the example of the UK as another country that had appropriations on an accrual basis. Excuse me. Clearly that hasn't gone so well in the UK. They've done a lot of work on the balance sheet and how they manage their balance sheet, but in terms of integration, that really hasn't happened. And perhaps the gap between the management of the balance sheet and fiscal strategy is illustrated by the fact that the production of the financial statements of the UK government are so slow that, for example, in the last financial year, the British government produced its financial statements 20 months after the end of the financial year, which tells me that the two are not really well integrated at all. The contrast is in New Zealand or Australia, where the governments produce monthly financial statements on an accrual basis, and the numbers in those monthly statements are significant in terms of the fiscal strategy. So the integration in New Zealand in a way is it's a kind of a pragmatic compromise which works off the principles of responsible fiscal management that are in the Act. But all of those are expressed in accrual terms. And so the numbers that you see in the monthly financial statements and in the annual financial statements are directly related to the fiscal strategy. So there's not really the gap between them that you would see in some jurisdictions where the two are almost kind of completely separate. I think I'd make the other point that I'd make is that I think one of the things that in that relatively small group of countries has worked well is that the appropriations and the budgets are on the same basis as the accounting, and it seems to me that it can only be problematic if the government is appropriating and budgeting on a cash basis but reporting on an accrual basis. It creates the sort of disjunction that you've got, that managers are operating throughout the year on a cash basis, and then at the end of the year they have to produce a set of financial statements. So those financial statements are not used for any practical management purposes within agencies, and it basically removes much of the incentive for having accurate, reliable information. It makes the accrual financial statements basically a after the event report, which has relatively little connection to fiscal strategy.
Thanks, Ian. Got a question which just relates to what extent does self-insurance by the government mute the risk signals related to government-owned assets from climate change impacts? So, perhaps interpreting that to mean that many of the assets might not be subject to kind of a strong risk financing or other approach. Interested in your views, Dog or Ian?
Ian, I think this is yours.
Yeah, I'm not sure that I have a helpful answer to that, Alistair.
Okay, I think just in terms of the questions coming through, I think we've sort of reached the end in terms of what I think is useful to be putting to Ian and Dog, given the nature of the presentation. So I just wanted to close by thanking you very much for taking your time to share your insights and experience with us today. And thank you very much to everyone online for participating and also for putting through your questions. So I'm going to close now with a karakia. So pikiti kaha, pikiti ora, pikiti wairoa, huie taekie. So thank you everyone for attending. And this will be available on our website. So mā te wā.
Thank you.
Thank you.